Yo, what's up, everyone? So, today I wanted to talk about how large corporations, with a particular focus on energy companies, are essentially us. Now, why am I talking about this? Well, currently, the hot topic is surrounding climate change and renewable energy transition. And, the narrative goes that if we continue to release an uncontrolled amount of carbon dioxide into the atmosphere, then we face an existential threat if you follow the logic of the science surrounding climate change. Now, I'm not here to argue the validity of the science or the claims made. That can be a topic for another video. But I wanted to shed some light about how there is an us versus them mentality when it comes to talking about the causes, right? And a lot of people don't realize, again, the topic of the video is that, with the narrative that the bad guys are, the large corps, energy companies, and then the good guys are, the people who champion climate change mitigation. They don't realize that actually, in a lot of ways, systematically, they're one and the same. Now, to understand what I'm talking about, we first need to talk about private and public businesses and how they kind of tie into society. So we'll start with private businesses. A good example, and I know that there's a huge range of talking points. There's private equity, there's public equity, but for simplicity's sake, a good example is the example of a cafe, right? A cafe is a good example of a small private business because typically the capital that's used to start up the business is from either the owner themselves, and they might arrange that with their own money, which they worked for, or through a loan from a bank, or if they have family and friends, right? And if the cafe does well, then happy days. Everyone who was involved is happy. And conversely, if the cafe, goes bust, then it's sad. But really, the only people who are affected are, again, the parties involved. Now, you compare this to publicly listed businesses, and essentially what they are is the opportunity for the public, hence the word, to invest their money into the assets which are traded on, the public market. And in Australia, that market is called the ASX. And I think in America, if you're watching from there, it's the S&P 500. And on this market, you have a range of riskier, more speculative assets and stocks, from like all the way from the IPO range, which means initial public offering, and they're private businesses that made it big enough to now consider going into the publicly listed market for their stocks and shares. And then on the other end of the spectrum, you have more safer assets and shares, right? And here you'll find like your big companies like Apple, if you're watching from America, in Australia, where I'm from, or where I'm talking from, you have your insurance companies, your banks, and there you will also find your energy companies. Now, to be considered a safe asset and to also be on the publicly listed market, you have to go through a whole range of compliance requirements, and you're kind of looked at under a microscope. And now you might be thinking, hey, well, I don't care. I don't invest my money into, energy companies, no matter how big they are. Well, chances are you actually kind of do. Because in Australia, you have what's known as a superannuation fund. And I think if you're watching from America, that's similar to the 401k. But long story short, essentially, it's a fund that is for your retirement, and your employer has to pay a certain percentage of your salary into this fund. And that's a non negotiable as well by law, at least in Australia. And if you do your research, you'll find that actually, at least in Australia, the majority of superannuation funds, 10% of their portfolio is actually exposed to energy companies. Now, what that means is that as a business, you have to have one specialty, and that is risk management. Now, we'll segue into this, and that essentially is the mechanism that allows you to continue operating and to continue being considered a safe asset, which also means that it ties back to the public, because then that continues to be an asset in which the public feels safe to rest their money with. Now, there's two types of risk management that's typically implemented by these companies. One is operational health and safety environment risk management, and the other one is financial risk management. So let's start with the first one. So if you're an energy company, let's take the example of a gas company, right? They will normally own a suite of assets, right? And these assets are normally wells and process plants. Now, to be able to build, operate, and maintain these assets requires the implementation of a suite of sophisticated systems and processes to minimize health and safety environment risk, and operational risk. Now, to do so, that requires leveraging industry standards. And there's a saying, right, that industry standards are built in blood. And what that's really saying is that over the long period of time, there's been, incidents, learnings, and industry maturity on how to maintain and operate these assets. And there's a status quo. So to do that, you also require huge amounts of capital, which again is fine if you have, a constant demand for energy or an infinite demand for energy in our modern world, because the amount you spend gets offset by the amount of revenue that you make. And for example, in Australia, one of the leading gas companies, they make around like $1 billion a year in profit, right? And so next you have the topic of financial risk management. So again, to be able to afford these, sophisticated systems and processes, you have to spend a huge amount of money. And with renewable energy initiatives, you're introducing variability and risk into the portfolio. And even worse, typically with these renewable energy initiatives, there's no market for them yet. So yes, you might have the technology available, but from a business perspective, if you want to stay at the status that you are, which is a publicly listed, safe, reliable asset, which ties back into society, you have to be incredibly risk adverse. Now, I'll finish up with the story for you guys. So I'm an engineer by background, and the company I worked for the last 4 years, they were working on a renewable hydrogen project, right? Not built yet, all in the engineering design phase, pre-feasibility stage. And they were on that for about 4 or 5 years. And long story short, the project got capped, right? And I'll give you guys the story of what it was like to be, in the office on the day it happened. So it's around like 10:30 in the morning. I was in a meeting with my manager, and my manager's manager was also in a meeting as well, and we were all talking to contractors, right, about just how we're going to build this project. And essentially, the project director, who wasn't in the meeting, he comes up and he interrupts all of us, and we had to end the meeting with the contractors, the external parties, and the entire floor kind of got funneled into this room. And we were told at 11:15 that the project was going to be cut, and that the entire team was either going to get made redundant or repurposed, if possible. And by around 11 o'clock, the news was circulated internally, and then shortly after, it was available to the public on the news. Now, I don't know the specifics as to why they chose to, end the project, but I know a couple of, potential reasons. And one of the really interesting ones was that actually, so the project was due to get the budget and the funding to be able to actually build. And the company decided to pull out regardless of the fact that the budget was approved, which is interesting. But it all kind of boils down to the fact that with hydrogen, as well as other renewable energy technologies, there's just no market for it. So the project had about one consumer that was going to actually buy the hydrogen off us, and that was for their decarbonization plan as well, their decarbonization strategy. But what that really meant as a business is that we would have to again change the status quo, the standard systems and processes, even more to incorporate a new technology, hydrogen, that has no promise of a market currently. So from a business perspective, it just makes absolutely no sense. And again, so if you tie that into how, as an energy company, you serve, yes, in terms of carbon emissions and climate change, you're typically the bad guys. But from an economic perspective, you serve the public as a safe haven for their money. And to maintain and to stay at that status, then you have to be, again, incredibly risk adverse. And so, again, that systematically also means that the behavior of your general public, right, your mom and dad investors, the people who, reasonably invest their wages, right, they are also connected to the large corporations and the energy companies that are emitting all the carbon. Anyway, if you guys found this video interesting, if you learned anything new, or if you have anything you want to relate to and share, please feel free to let me know in the comments, and don't forget to like and subscribe. Cheers.